Well, it's exciting times in the small cap world at the moment, definitely. I mean, we've had 4 takeovers in only 8 weeks. And that's come about because of what we've been talking about, the uncertainty associated with increased volatility in the markets generally and the falls last year. So what we've also got is a depreciating Australian dollar, which makes it a much better value for some of these offshore corporates in terms of getting bang for their buck in the Australian corporate scene. So we are excited about more activity on this front, but I guess you don't invest in a company based on it being taken over, but when it does happen, you get a 50% increase in the share price on the day. So you're not gonna say no to that. We are positive on dividends. I mean, it's pretty hard to be an Australian investor and not be positive on dividends. They're good for big and small companies. They're good for investors. They provide a price signal to investment, and they also provide incentive for companies, in Australian listed companies, to provide, as in terms of shareholder returns, a good dividend. So I think that anything that detracts from that is a negative. But I think honestly, after the Victorian election occurred, there was an expectation that there would be a shortened Labor government. So we think that it's priced in the effect of the changes to the dividend franking credits that they're proposing. And I think also that those changes, while important, don't, and we outline those changes in detail in issue 331 like a couple of weeks ago. While they are important, they're not nearly as important for investors as growth. I mean, you don't invest based on tax. You invest based on a company increasing their profits and those increases in profits being partially returned in the form of dividends. So dividend growth is what we're about, and that's what small caps are about, and even big caps. So that's what we're focused on. You're not going to hit it out of the ballpark if you don't swing, and luckily we've taken some swings at Nearmap and Nanosonics, two of which come to mind. Those are companies that are really achieving strong growth globally. So their products are being taken on by especially in the case of Nearmap in the US market, and actually both of them. But it's important also to realise the kinds of risk that occurs when you're getting these inflated prices for assets. So it's important to take profits. I mean, that in this kind of market where there is more volatility, there is more skepticism about growth occurring ad infinitum. When you get opportunities to take profits, you need to take them to at least realise some of those gains, especially for stocks that aren't paying dividends. I think what we saw in reporting season was a lot of uncertainty because consumers are rightly nervous about the election, and I think this is reflected in the company's outlook statements. One stock that fell off owing to Australian weakness was GTN. You might know Vic LaRusso. He's a director. They provide traffic reports. So this is a company that had some short-term reductions in their sales, which led to magnified reductions at the bottom line because there's high operating leverage. But operating leverage can work two ways. So we think that when they rectify, and they are rectifying the situation, this operating leverage will work for them in a positive sense, and that's what's occurring in the share price. So GTN is definitely worth having a look at. Also, I think that the stocks that have been taken over, Netcom, Spices, Ruralco, to name a few, they've all been suffering prior to those takeovers. They were companies under a lot of pressure, their share prices, which is why we had a look at them. So that reflects uncertainty. But what they did have was a strong market position. They had relatively strong balance sheets to finance the growth potential. So I guess you have to, as an investor, step in when there's uncertainty, and you can see that the downside is somewhat limited, and you can get that 50% climb in one day. So you have to position yourself to be as an investor to take advantage of those opportunities. Well, buy, hold, sell's always always much anticipated, but I guess in this environment, buys are more anticipated than anything else, because we are in a kind of a market where there are lots of opportunities that haven't been, and that hasn't been the case for a while. One stock I was looking at for a while, and I was just thinking, what's wrong with this company is GBST. They do financial services software. I mean, I'll be honest with you, I thought something was wrong with this company because the stock price kept going down. So I thought, is their technology being superseded? But we used our industry contacts, and we also waited to see the first half result before stepping in. And I think that this company is definitely going to continue the momentum we saw in the first half result and take advantage of the 50 million or so they're spending in growth technology. So I think that there's still a good opportunity in GBST, and the stock's moving in the right direction. There's a lot of companies that we have in our portfolio, and we're looking at increasing the portfolio. One of them is the Reject Shop, which is definitely a stock that's had a bumpy ride. I mean, any retailer's had a bumpy ride, but these guys had a couple of profit downgrades. A lot of brokers wrote them off, but what they did get was a speculative bid from Rafael Gaminda, and we think that sort of underlines the value that's in the stock, even though the bid has subsequently fallen away. I mean, these guys provide products that are off the beaten track sometimes. They do fast-moving consumer goods, so stuff that people need no matter what, on the other hand. But, they did have a good December. And I mean, sales of tinsel are up. Who doesn't want tinsel as a cheap way of impressing the kids? So that's what you want, stocks where you're not being asked to give too much, both at a retail level and at a share price. So we think it's still good value. One stock that's more than trebled, almost quadrupled, is Alliance Aviation. I mean, that company's really turned their operations around after the fallout of the mining services sector in the financial crisis. They've sort of broadened their offering, and subsequently, as part of the reward, Qantas has taken a 20% or so shareholding. So Qantas have their foot on the jugular, but we don't think they're going to move anytime soon. We don't see the incentive for them to move to take over the whole thing. So we think it's one of those cases where you need to be taking profits when you've had such big gains. What's coming up is particularly exciting at the big end of town for Under the Radar in the Blue Chip publication, which has received a lot of support, a lot of demand. We're taking that fortnightly, so we're doubling our output from monthly to fortnightly, and we're introducing price ranges for investors so that people have a clear understanding of where we stand. We're also going to be covering some new small cap stocks in the near future, which we've seen. So some new stocks to buy. Lastly, we're going to be doing the dividend portfolio, because I think now in such times of volatility, dividends do reduce the uncertainty in your portfolio and give you more comfort for the future.